everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for joining me for our latest financial education video. Now, it's been all over the news what's been going on with the banks recently, so I want to address the 5 key questions that are on most people's minds. And as you can see by the title here, I'm going to be talking a lot about is 2023 a deja vu of 2008. Let's get right into it. All right, so number 1, what happened? So essentially, Silicon Valley Bank and a couple other smaller crypto banks actually got shut down by the FDIC last week for not having enough liquidity in their accounts to pay out all the depositors. You see, what happened was a classic run on the bank. If you've ever seen the movie It's a Wonderful Life, one of my favorite movies, by the way, you know that when banks make deposits, they're working on a system called the Federal Reserve or Fractional Reserve System, which means that they don't have to have all the money sitting there at the vault. They actually can invest the money, lend the money, and that's how they make money from your deposits. So not all the money is available. So what happens if everybody shows up at the bank at the same time and they want to make a withdrawal? Well, they can't do that, and that's essentially what happened to these banks. And there's a couple other banks that are kind of on the fringe because they're also kind of in that same boat. So let's talk a little bit more about why this happened. Okay, so it all started with the pandemic, all right? So everything got shut down, a lot of people weren't working, and the federal government had multiple stimulus programs. And also, the Fed had lots of quantitative easing, which we won't get into as much on this video, but it's more pertinent that we had these big fiscal stimulus checks that ended up going out to people directly. And you can see the dramatic difference between 2001, 2008, and recently in 2020 and 2021. We almost had $1 trillion worth of checks that got sent out to ordinary people. So what happened is people that weren't spending that money right away took that money and deposited them into the banks. All right, so you would think that all this money going to the banks would be a wonderful thing for the banks, but it can actually be a little bit more of a curse than a blessing, especially as you look at this chart. Is the Fed, because of all that inflation that started to come through the system, started to raise rates. And this blue line, the dark blue, shows the current cycle that the Fed has been on in raising interest rates. So why does this matter? Well, when they raised interest rates so fast, it made the price of the bonds that all the banks were buying with all this excess money, because they weren't lending it then. Nobody was starting a business in 2020. Well, a few were, but it was definitely not like it was pre-COVID. And so the banks were investing that money, and they bought bonds with it. Now, the bonds are good quality bonds, but they bought these bonds that had long maturity, especially Silicon Valley Bank. That was one of their big faults. And as rates go up, it's like a teeter-totter. Rates go up, the value of the bonds go down. And then the final clincher came when the yield curve became inverted. This is what we're looking at here. This is the shorter term interest rates are higher than the longer term interest rates. This is a very unusual thing to happen, but it's usually a precursor to things slowing down in the economy later. And so essentially, we're living through this right now. And what happened is the banks had to pay higher interest rates on their deposits, and on the loans and all their investments, they were getting lower interest rates. So they were fine as long as nobody came in and cashed things in. But as you heard from the beginning of the story, they cashed in. And in fact, they weren't able to pay these higher rates like in treasuries are paying right now. They were paying much lower rates. So what happened is not only were people concerned about their money, but they also were just taking their money out naturally to invest in other higher yielding short-term instruments like treasury bills than leaving it in their savings or checking accounts. Again, more extraction of that money that came in during the COVID period out of the banks. All right, so here is the bottom line to what happened with SVB and some of the other banks that are in some hot water right now. As the Fed raised rates, the price of their treasury bonds were going down. The orange shows all the unrealized losses from their bond portfolios. So hopefully they weren't going to have to sell those bonds at a loss. But they had to, because they had a lot of people making withdrawals based on what I was just telling you about. And so they had to realize all these losses, unfortunately, on good bonds. They just had to sell them before they matured, and because rates were higher, the prices were lower. So they had big gaps in their capital, and that's why FDIC had to swoop in and save the day. So let's talk about what's next. What did the government do? All right, so last week, this is a pretty big deal. The Fed came out and said that they were going to set up a temporary lending facility for these banks. So not just SVB, but any of the banks that might run into a liquidity crunch. Essentially, they're going to lend them money based on their bond portfolio, not at the depreciated value, but at their full value, so that they could borrow money without having to sell them at a loss and have that liquidity. So that was huge. And then the second part, some of these banks, especially Silicon Valley Bank, had a lot of money that was above the $250,000 FDIC maximum. And so what they did, they essentially said, you know what, if you have more than the 250, we're going to guarantee the funds above that as well for those particular banks. Now they're kind of implicitly also saying that they are going to do that for all the banks out there, although they haven't exactly said that. But that also relieved a lot of the pressure and hopefully build some confidence back into the banking system. What we've seen is that it has had a very positive effect, but of course there's still a lot of uncertainty out there. So question number 4 is, what is the impact? Oh, the first thing I would point out here is you can see on this chart, this is the VIX, which measures essentially the volatility, but it's fear. And so what you can see here is it's been spiking lately. And of course, there's been a lot more volatility in the stock market because of this, and because there's so much uncertainty. I do believe that this also raises the probability of there being a recession sometime this year, and we possibly could even be in a recession now. When they look at the data, oftentimes we find out we were already in one. And so that definitely raises the probability of it going from no recession to a recession, or at least from a soft to maybe more of a mild type of recession. All right, the other large impact has been on the path of what the Fed is going to do with interest rates. So before all the SVB stuff, we had this light blue line. And what it shows is what the Fed was most likely going to do with interest rates. So they were probably going to keep raising, probably here in March, and probably in April and May, and all the way through July, and then maybe start to taper down after the summer. But now what's being priced in is that they're going to maybe do one more rate hike, and that's even questionable. But then that's pretty much it, and they're going to be lowering rates pretty quickly. So this is a massive shift in just a couple weeks in what's projected to happen with interest rates. And so the impact of this could be huge. First of all, it's making all of the bonds in our portfolios go up. It's weakening the dollar, which is making international investments look a little bit more attractive, and especially gold look a lot more attractive. And so it does change things quite a bit. We'll just have to monitor this to see if this is really the path that the Fed takes, but it does look very likely. Of course, I saved the best question for last. Number 5, is 2023 going to be a repeat of 2008? And so I can get into all the guardrails that were put into place back in 2008 after the great financial crisis, but that gets a little wonky. So I wanted to leave you with this chart that I think summarizes the biggest difference between 2008 and 2023, because as you can see, I don't believe it's going to be a repeat. As you can see here in 2008, which is what's being focused on here, the bank cash and treasuries as a percent of total assets was pretty low quality. Less than 15% of the total assets was in cash and in high quality debt instruments. As you can see today, the percentage is much, much higher. So the banks are in much healthier, much stronger position than they were in 2008. So that's important to understand. That doesn't mean that they're completely insulated from everything, but the probabilities of something catastrophic like what happened in 2008 definitely seems a lot lower probability. In fact, what's really happening here is not that the banks took these crazy risks and had a lot of credit risk. What they have now is more of a liquidity mismatch. They have good quality bonds. They just didn't have enough of the cash on hand without having to sell things that maybe were down temporarily because of the rates to pay everybody and be whole. So I think that's why this lending facility that the government is bringing out was actually a pretty smart move and will probably make a big difference, and we're starting to see that already. Now, could there be some shockwaves from this? Yeah, I mean, I don't have a crystal ball, and I think there certainly could still be some shockwaves from this, so I wouldn't go in there and start getting super aggressive here right now. It's probably time to be cautious. Make sure you're well diversified. Have your bonds, have your gold, have some non-dollar denominated assets to well diversify your portfolio. So that's important to remember. And it's also important, I think, to remember that you probably shouldn't have more than $250,000, or if you're, a couple, $500,000 in cash at a bank, because you just don't know. FDIC will probably take care of things, but is it an explicit backing for everybody? That remains to be seen. So avoid that problem from the get-go and just avoid going over those maximums, just to play it safe. Okay? Thanks for watching, guys. I hope this was helpful. If you have any other questions, please feel free to reach out. I am here to help. Thank you, and God bless.